Good afternoon, everyone. It's Adam Bloch here from Fusion Recruitment, part of Fusion Consulting. Thank you very much for joining. We will be starting our session in just a few minutes. We're allowing a bit of time for people to join. So just bear with us a few minutes. Good afternoon, everyone. As I said, it's Adam Bloch here from Fusion Recruitment, part of Fusion Consulting. Thank you for joining, and delighted to welcome you to one of Fusion Recruitment's first webinars. We do hope to be doing more of these webinars as the year rolls out. But thank you for joining. Very excited to be here. We're here to look at the world of debt, the good, the bad, and the ugly. And the main topics are how to capitalize your business in current economic conditions, and we will be considering multiple sources of debt. Just a little bit of housekeeping before we get cracking. I'm going to do some intros and welcome my co-host Chris Smith, and then I will do a few moments on Fusion Consulting, Fusion Recruitment, and then Chris and I will have our fireside chat discussing the world of debt, and then we'll have some time for Q&A, and then we'll summarize and we'll go from there. So it's great to have you all here. Okay, so Fusion Consulting Group. Some of you will know Fusion Consulting Group and some of you won't, but for those that don't, we are one of the most interesting, fast-growing professional services business out there in the UK right now. We are private equity backed. We're going through our own growth journey. And as you can see, we have a number of lines of business. We take a fully integrated approach to both our private clients and our corporate clients. And as you can see, lines of business include tax. We have a fantastic tax team that reaches out nationally and internationally, particularly focusing on tax advisory and tax compliance. We have we are an accounting firm. We provide independent financial advice, Fusion Financial. We have legal services, looking at a range of different corporate and individual transactional support, consulting. I run Fusion Recruitment, and we do also have an international network of partners. So whether you're a private client or a corporate client looking for work, looking for support, please do feel free to reach out to me, and I can put you in touch with the right people. Okay, so just want to introduce Chris. So Chris, thank you very much for joining. Some of you might have heard of Chris before, some of you not. But Chris, what can I say about Chris? I've known Chris for quite some time, really enjoyed working with him on similar sorts of events over the years. He's Scottish, not that means anything necessarily, but he's from north of the border. He spent time at Edinburgh University studying psychology, and then spent 10 years with the Bank of Scotland, and has spent over a decade working as head of debt and partner at Clearwater Corporate Finance. But what people don't know about you, Chris, if they look at your LinkedIn profile, is that you have also swum the channel, and for that, I think we can all look at you with awe. So look, welcome, Chris. Just a quick note. I mean, how did it feel swimming the channel? But just put it out there.
I won't do it again. Let's put it that way.
Fair enough. Fair enough.
I'm really pleased, Adam, that you weren't going to introduce me as the ugly part of the debt.
No. You're the positive part of debt, and clearly a man of resilience and determination. So look, thank you for joining. Okay, so just a quick couple of minutes on Fusion Recruitment. We're actually new into the business. We were acquired recently, but as you can see, we focus on executive search and recruitment dedicated to finance, business and operations. So we kind of work in the world of the finance function, the operational functions, and the human resources functions. So kind of the guts of a business, the back office of the business, helping business leaders with their ambitions to grow and be successful. So what do we recruit? Very quickly, we recruit at the executive level, and you can see on the current slide the variety of positions for which we recruit. So that's the leadership level. We also build teams behind the leaders, and we put people into situations on a contract basis for the short, medium, or long term. But we've had, between us all, we've had over 15 years of experience working with extremely young companies that are just starting out, helping them look at the resource that they need to grow. We work with more established companies, high net worth backed, family office backed, venture capital backed, private equity backed, the growth to mid cap environment. And we also provide a service called CFO as a service. So if you're a young company looking for some support from a chief financial officer or a finance director, could be, I need to get hold of my finances and the control of the business, or you may, in addition, require some support around making good business decisions, good investment decisions to support your growth. And you are able to do that without spending too much money. And we can put people into your business on a part-time basis, or that may be 1, 2, 3 days a week, or indeed it may be once a month, whatever suits your business and whatever suits the cadence and growth of your business. But it's all about the right guidance to help you grow. We've worked with 1,000 young companies that probably none of you will have ever heard of, but just to give you some credibility about the kind of clients that you will have heard of, you can see there's some wonderful household names like M&C Saatchi, Conran, and SoundCloud. But I can reassure you that we work at multiple ends of the spectrum with very young companies and companies that are beginning to scale. And these are the kind of situations that we find ourselves in, where we have conversations. Again, early stage startup might be that you're looking to fundraise, but you don't have enough financial or operational support to do that. It might be that you haven't got enough bodies in your business for certain projects. Or it might be you're really beginning to realize that there isn't enough control, or you don't have enough commercial expertise, and you want another experienced head to help you through the challenges. As head of Fusion Recruitment, I'm here to have conversations with you. And these conversations may not lead to work for Fusion Recruitment, but for me, it's all about building relationships and strong advisory relationships to help you through your challenges. So please do reach out if you want to think about your hiring strategy, even if it's way in the future. So there we go. That's all about Fusion Consulting and Fusion Recruitment. So Chris, it'd be good if you could just maybe give us a couple of minutes on your background, just so that the guys out there are aware of who's giving them the advice. That'd be fantastic.
Yeah, sure, no problem at all. So thanks for that, Adam. I'm a partner in Clearwater. I've been in Clearwater now for over 13 years, coming up to 14 years this year, actually. The firm itself is 20 years old this year. It's very much focused on advising companies, boards, shareholders on most things in relation to transactions. So we're a lead advisory firm. We're very much focused on the mid-market. We have offices in the UK. We actually have 4 offices in the UK: London, Birmingham, Manchester, and Leeds. But we also have another 13 locations across Europe, across 10 different countries. There's the best part of about 400 people in Clearwater. It's become, over the years, through various acquisitions, quite a large business. As I say, focused on mid-market, focused on helping founders of businesses, entrepreneurs, with raising money, exits, even helping people acquire businesses as well. My part of the business, the debt part of the business, is very much focused on helping people access debt capital, which we'll come on to talk about, Adam. But the landscape for debt capital has changed dramatically over the course of the last 15 to 20 years, which has been for the benefit of somebody like me as a debt advisor, because it means there's a requirement for people to require help in navigating what that landscape looks like. But we have 20 people in the team in the UK who are focused just on doing debt advisory for our clients, and there's about another 20 people across Europe as well focusing on doing that, which makes us probably one of the larger pan-European debt advisory businesses at the moment. So we do, I'd say, roughly 100 transactions a year, which means we've got a really good idea of what's going on in the marketplace. And those transactions are across all different sectors, all different types of businesses, all different types of structures. So we've really got our finger on the pulse in terms of where the debt markets are.
That's great. Thank you, Chris. And one of the things I've always enjoyed about working with you, Chris, is I think you're just rather like me. You're always open to conversations, even if the individual that you're talking to isn't necessarily looking to act soon. You're more than happy to spend time with the people to give them the right advice for the medium term and long term future. So I think you have a very like-minded approach, and it's great to buddy up with you. Okay, well look, thank you for that, Chris. Let's get into the meat of it. Let's get into the main section. Look, I mean, the economy today, industry today, I mean, it's an interesting scenario out there. Just noting a few things that are going on in life right now. We've got TikTok, who's fighting its corner in the US. We've got the interest rates that are bottoming. We hope will bottom out as soon as possible. It would probably help us all. Facebook's still under fire in terms of some of its data issues. The cost of living is still high. For those that live in the northeast, I'm sure they'll be delighted that Newcastle has qualified for the Champions League. Unfortunately for me, second time in a row as an Arsenal supporter, we bottled it at the end of the season. Nevertheless, we've had a good season, and we're also in the Champions League. So there are some positive vibes out there. But I've been to a few events more recently, investor events and professional services events. And, I'm really pleased to feel the positive vibes that are out there. I mean, it is challenging. Excuse me. It is challenging from an investment perspective. It is challenging from a business perspective, but there are positive vibes out there, and it is all about confidence. So that's what we're here to do, to help give those that have joined a little bit of confidence. So, Chris, just talk to us a little bit about the general debt landscape. What's it looking like right now?
Well, look, so I think it's no secret that the last quarter of last year and indeed the first quarter of this year, uncertainty, as you mentioned, there's been quite a lot more uncertainty than just the data points you've mentioned there. It has really affected lender appetite. It's not only affected lender appetite, actually, it's also affected vendor or your client decision making as well. And when you've got that situation, it usually means that the market ends up being a little bit slower. So we have seen the credit quality bar go up from lenders. but we've also seen clients a little hesitant to make, they want to invest in making an acquisition, but is today the right time to do it? Maybe I'll just wait a little bit and see what happens. I need to invest in growth in the business through capex. I might just wait a little bit and see what happens. So a little bit of uncertainty has definitely crept into the market. The positives, though, are that there is, the market is actually open. This is not like the global financial crisis in 2008 and 2009. There is capital available for people to borrow, for people to invest. As I said, the credit quality bar is quite high, but I'm not sure that's necessarily a bad thing. Banks are, if we just talk about the high street banks, their balance sheets are very well capitalized. They're in much better positions than they were 15 years ago. And over the course of the last 15 years, new categories of lenders, which tend to get grouped in the alternative lending bucket, but there's a lot of them across the spectrum of debt structures. They have arisen. They've raised capital from third parties, from other investors, and there's a huge amount of capital out there, which at some point needs to be invested, and those funders will start to feel a little bit of pressure to invest, because unlike banks, they do need to invest. They only make a return on the money that they lend, and they have relatively limited periods in which they can lend that money, under a fund structure, which means, again, we'll start to see, I think, a bit more pressure coming through from those lenders to try and find places to put that debt. We actually did a survey at the beginning of the year. We spoke to over 50 lending institutions just to get a temperature test on where things were and where various metrics are. And I think the result of that, and it's on our website if anybody is interested in having a look at it, I'm quite happy to send through a link to it as well. But fundamentally, the market's open. Pricing's a little bit more than it was, but not that much. Leverage is maybe a little bit down, but not that much. Again, that's probably more to do with affordability than anything else. Underlying interest rates are a lot higher than they used to be, so debt costs more as a result of that. But fundamentally, I think, the debt landscape is okay.
Well, that's that's good to hear. We may well want to send out that link for you post the event today. So look, whether one is an educated buyer of debt, or perhaps it's someone's first time, an interesting question would be, what are the alternative finance products that are available out there right now? And I guess sort of more importantly, or as importantly, why might they suit certain companies set against the economic conditions?
Yeah, so 20 years ago, banks basically underwrote everything, and they pretty much, if you wanted to borrow money, you went to a bank. That landscape is very different today. Banks are much more risk averse. So actually, if you're in a situation where there's a potential lack of confidence in where the market is, then banks are obviously going to be a little bit tighter in terms of who and how they lend. But there's plenty of other ways that you can access capital depending on what you're trying to do with your business. I suppose the simplest way to think about that is, if you've got a business that's got assets, it is possible to leverage against the value of those assets. And the type of assets that lenders will lend against has increased dramatically over the last 10 or so years. You have kind of traditional assets like debt, debtors, stock, plant and machinery, but now you have specialists who would also look at royalties, annual recurring revenue, particularly if you're a software business. Intellectual property, valuation of that. Some lenders are happy looking at potential value of litigation rights that you might have, and we're seeing people specialize in renewables. People who are happy funding. People who are setting up networks. There's obviously a lot of infrastructure investment going on with putting full fibre broadband into the UK, and there are lenders out there who are funding that where there isn't necessarily income streams to begin with. So there are different ways to look at your business and the ways that you can potentially fund that. Going a bit further, if you've got a business that's got real estate assets, it's not just mortgages anymore. You can also look at doing ground rent deals or sale and leasebacks. So there are again specialist lenders who are interested in doing, looking for long-term, yielding opportunities for their capital. Obviously, if your business that's light on assets, that's going to be a bit more challenging. So you are going to come down to looking at what your cash flow looks like. And there are a range of different lenders now focused on cash flow lending. So everyone's heard of this, the challenger banks. There's actually quite a few businesses now who would be classed as challenger banks, and actually a lot of them were quite active lenders during COVID, with the government guarantee in place called C-bills, which allowed some businesses who were struggling for cash flow to be able to access that. A lot of these alternative lenders were the people who provided that and have continued to support businesses going forward. And then we've got a whole load of private credit funds who have set up with a range of different focuses. Some of them focusing on the small end of the market, supporting businesses that are growing and investing. And others, theoretically, it's possible to get, more than $1 billion of debt underwritten by one single credit institution. So there's a real sort of broad, a range of lenders that are out there, and I think fundamentally, you can probably fund most situations now. The key thing really comes down to what the cost of that funding is going to be, because one thing these lenders do is they provide relatively flexible lending, but they are pricing the risk of that lending. So it's quite often you will see that being more expensive than what you would expect to pay for a high street bank.
That's really interesting. It seems to more products available than perhaps one might expect. But again, it's about getting into the detail. So we've mentioned the economy a couple of times. How is the current economy impacting the variety of debt products out in the market? Is it having a major contribution on the makeup of these deals?
I don't think it's having a contribution on the makeup of the deals. No, I'd say said before, our survey sort of said nothing's really changed. I think affordability is the key impact. If we are seeing some businesses where trading is starting to soften a little bit as a result of cost increases in their businesses, but particularly wage inflation, given the cost of living crisis. That's become for businesses that are quite reliant on human capital, that's become quite an issue. A lot of lenders are very interested in how can you pass on cost increases through your business. But really, I suppose it's underlying interest rates. If you think about it, we've been getting fat on artificially low interest rates for the last 12 years. I think what a lot of people forget is that 20 years ago, 15 years ago, underlying interest rates were somewhere between 4.5% and 6%, sometimes 7%, and they moved around. When the MPC sat every month. I remember having a variable rate mortgage and waiting in anticipation every month to see how much more or less my mortgage would cost. I think everyone's got very sort of used to debt being cheap. And the underlying interest rates now, if you're looking, you probably shouldn't just look at what the rate is today. You should probably look at what the kind of forecast is over the next 3 to 5 years as a real kind of view about how much debt is going to cost. And rates are circa 4%, so maybe even slightly higher. So it's all of a sudden you've got probably half, maybe a little bit more than that again on top of what you were paying for your debt today. So the result of that is the amount of debt that you can borrow has probably come down, because obviously you want to make sure you can still afford to pay it and repay it.
Yeah.
But we're also seeing other kind of structures coming in. So, for particularly private equity backed businesses, some lenders are quite happy to put non-amortizing facilities in place in order to preserve cash and ensure it's available to invest in the business and also pay interest. And we're also seeing some lenders being comfortable having a proportion of their debt actually not interest paid, commonly known as PIK, or payment in kind, so effectively rolling up on the balance sheet and providing more cash for the business to be able to grow and invest. Clearly that needs to be repaid at some point in the future, so that's all part of the risk analysis. But we are seeing some interesting structures being put forward. At the smaller end of the market, what we are seeing, actually, a lot of banks, and it's been around for a while, to be fair, but banks really pushing asset finance for smaller businesses. That's probably for a selfish reason, because it's a lot better for their bank capital efficiency to have fully secured facilities, and also it means they can run them much more efficiently in terms of account management as well. But yeah, the main impact, I guess, is just some uncertainty still, but their products, I think, there's still a lot out there, and as I say, I think there's still the opportunity to finance pretty much any situation if you're happy with the cost.
Well, that's good to hear that there's still a variety of products out there. So we've been dealing with the what so far. There is capital available. Credit bar is high, but there are more products available than perhaps expected on the market. Affordability is key, and you could start on the smaller end of the market. You could start with your bank and see what they have to offer. But let's come on to the how. So starting with depending on what type of buyer of debt one is, again, whether you have done it many times before or whether this is your kind of first time out the gate, what would your best advice be relating to understanding the market and actioning the purchase of debt?
So I think, regardless of whether you're sophisticated or unsophisticated, and I would suggest that probably, it's down to experience, isn't it, really, more than anything else, whether you've raised debt before or not. I think the key thing to do really is to not just wade into trying to raise debt. I think at the outset you need to define what your objectives are. Most people would probably say that how much they can borrow and how much it costs are their key objectives. I can tell you with the experience of having done hundreds of deals that is not usually the key objective when it gets down to decision making. Actually, you've got to think about other things like what's the use of cash. You borrow money, but if you've borrowed it cheaply and the bank are wanting to restrict what you can do with it, that might have an impact on your ability to grow your business. You've got to think about what covenants and controls are going to get put in place on your business. You've got to think about actually, why am I borrowing this money? What's key? What's really key for me? Am I prepared to pay a higher premium for that debt if it's going to give me the opportunity to double the size of my business? That feels like a totally wise investment decision, but obviously you've got to think about what the downside risks are associated with that as well. So the best thing to do at the outset is properly define your objectives. Yeah. That's what we do when we sit down with the client. We don't just dive straight into the process. We sit down and say, what are you actually really trying to achieve, and what is the most important things to you, and almost get people to list them, because that allows us to then work out, when we're giving advice to clients on the most suitable lender for them, to be able to accurately assess them against the needs of the client. I think I've said it before, if you're smaller, relatively unsophisticated, if the requirements aren't particularly huge, then you probably are better starting off with your bank, to be honest. A bit of that, though, is going to depend on where your relationship sits within the bank. And a lot of smaller businesses are dealt with on a very local level. And when I started banking a while ago, local bank managers had real autonomy. They had the ability to make decisions to support their customers. And that has long gone, to be honest. So actually, I think where a lot of businesses get quite frustrated is they have a bank that does their day-to-day banking for them. They go to see them about a great new initiative that they're trying to do for the business, and the bank and the guy just says, "Oh, this is outside of my pay grade." So you get a negative response. Whereas actually, a lot of these banks are trying to support smaller growth businesses. It's just about trying to find the right people within the bank to be able to do that. So again, it's sort of trying to push your relationships with your bank is probably the best place to start. If you really are banging your head against a brick wall, then you might want to consider asset finance if you've got assets within the business. Outside of that, I think getting someone to give you some advice to go and look at some of the alternative lenders out there is probably the next best thing to do. The other thing I would also say is the job of an FD or a CFO is not to raise debt. The job of an FD and a CFO is to run the finances of the business and provide strategic advice to the board and all of those kind of things. So most FDs, CFOs will raise debt, I don't know, 3 to 5 times in their lifetime, maybe slightly more, depending on what situations they find themselves in. So they're not in the market all the time. They don't know what's in the marketplace. So actually getting some proper advice and sounding on what to do is probably a good start, to be honest.
Yeah, I mean, I would agree with you. Whether we have dealt with companies that don't have a finance lead in place, or even if we're dealing with a company that does have a finance lead in place, we've often found that the skills to raise debt or the experience to raise debt it isn't sitting there, and there is no shame in terms of hiring that resource in for a period of time, not to take over an FD's role or a CFO's role, but more to support the transaction process. And again, also look, you're talking about that you may well get to the point where you need to seek the advice of you and Clearwater in terms of the best way of defining objectives. I find that quite interesting that you said that you define the objectives, but actually you have a business that comes into you that defines the objectives, but actually when they leave, the objectives were slightly different. I guess that scoping process is all important in terms of the credibility to eventually close a debt transaction.
Yeah, absolutely. Yeah, well, it's an important part of your negotiation process, because if you're negotiating over things that aren't important to you, then you're not going to end up with a banking package or even a lending partner who's going to be appropriate, and you won't end up with I suppose the ability to grow the business in the way that you want to.
Yeah, absolutely. Okay, thank you. And it's funny you talk about how things were 20 years ago. You talk about your own your own experience with a mortgage, etc., and how things have changed. I always wondered in terms of raising money and debt. Is it the need that drives it, or the market that drives it, and who's really at the top of it? But that's probably a more esoteric question to leave for another day. But over the years, have processes to secure debt changed at all? Has due diligence tightened, for example?
The process has definitely changed. As I said, 20 years ago, you probably just went to your bank and said, I need to borrow money. If you were a really big business, they'd say, yeah, that's great. And they'd lend you the money and then find other people to sell that money down to. If you were a smaller business, then they probably would provide that capital to you. So, now actually the process is a lot wider. you've defined your objectives, you know what you're trying to achieve. Not every lender is going to be able to achieve all of your objectives. So by default, you need to go out and run, I think, a relatively wide process to ensure that you're getting capital and a partner in that's going to meet those objectives. So yes, process is probably a little bit wider. It's definitely more time consuming than it used to be. Particularly bank credit processes take longer. They're much more structured. Credit committees sit specific points during the week. The deal teams within the banks have to get their information in, a certain period of time ahead of that. You have to answer the questions ahead of that. It's, the questions that are being asked ahead of time are probably a lot more detailed, potentially, than they used to be. The things that people ask about, the topics change a lot. ESG is really, really hot at the moment. So there's a lot of questions about sustainability impact that people that lenders want to understand. Some of them because they are offering better deals if you're an ESG positive business. Some of them because they just need to tick it off from an internal governance point of view. And there are various other things that they just need to cover off. And also, each lender will have a slightly different nuance as to what is important to them compared to others. It's definitely got longer, more information, more prep required. It's worth saying that some of the alternative lenders, particularly some of the funds, can actually move quicker if needed. What you tend to find sometimes is that the guys who sit on the front line, the deal teams in those funds, some of them, senior ones, may also actually be on the credit committee as well. So you are talking with decision makers, which tends to help in terms of thinking about deliverability. But overall, the level of information they need is still the same. You asked about due diligence. I think that has changed over the years. It's unless you're with an existing lender or you're borrowing a relatively small amount of debt that's probably well covered by assets, most lenders would probably now want some level of third-party due diligence. Undoubtedly financial due diligence, sometimes commercial due diligence as well, depending on what the ask is. The scope for that work probably hasn't changed. It's just I think it has become more prevalent over the last few years. So you need to bear that in mind in terms of the length of process. There's a decision to be made because there's cost involved, obviously, in commissioning third-party diligence. So do you do that diligence up front in order to save yourself time? Or do you wait to see what the interest from lenders looks like and what the key topics are going to be of inquiry from them before you commission due diligence? Obviously, if you do the latter, you're building a lot more into the timeline in terms of the process. So what could take a couple of months if you've done it up front could end up taking 3 to 4 months if you're trying to fit a due diligence process in the middle.
Yeah,
there's obviously a bit of risk with putting due diligence in the middle as well, in that you've told some lenders what you think your business is doing and what it's going to do, and if the diligence then comes up with a different answer, that can very easily derail a process. So it's worth thinking about that, but diligence is obviously a big part of it. Some people will do their own due diligence, particularly if it's really highly specialized. But I talked about some lenders who will look at royalties, ARR, intellectual property. So some lenders will do their own diligence on those types of assets. The other point just on diligence to mention is, when the market gets really, really busy, there are only so many due diligence providers out there. And we saw this after, so the back end of 2020. So we all went into hibernation for COVID. In September 2020, the market went wild. There were a huge number of M&A transactions that happened. I mean, we as a business transacted a whole year's worth of work in the space of 6 months.
Wow.
And that had a real impact on the DD providers. It was a real premium to try and get hold of due diligence providers. So again, at the moment, that's fine because the market's quieter. There's lots of DD providers out there looking for work, but when things start to get busy again, and the view is it probably will get very busy in the second half of this year again. That's something just to think about as well.
It's interesting. It does speak to the need to plan, whether you're relying on yourself or brought in resource or outside agent help. It does speak to the need to plan as far ahead as possible, so that once you get the momentum of the deal going, you can see it through properly. And just a little bit more detail on what qualifying factors are lenders looking for these days? What are the highlights there?
They're fairly obvious, to be honest, and I don't think they've changed particularly over the years. But lenders really like resilient businesses, so good track record, obviously very helpful. COVID's reasonably far behind us now, but again, there's still a bit of that kind of how did people perform post-COVID, with any kind of bubbles, all of that kind of stuff that lenders do look at. But strong, resilient businesses obviously are going to get a lot more time with credit committees. That links into then actually, having quite defensible underlying market drivers as well. So having a strong track record is fine. If you've got a market where actually there's some really good drivers, that's very helpful. Strong market position. That's if you're a leader or one of the leaders in your business, and that's going to be very helpful. And if sorry, can everyone still see me?
Yeah, absolutely.
Yeah, hold on a second. Sorry, my IT has just gone down. Hold on, I'm back.
We've got you back. We've got you back, Chris.
Slight technical issue. So if you're the leader in your market, or one of the leaders in your market, particularly if there's a quite big gap between you and the next person, that's definitely going to be something where lenders are going to be very positive. And then the biggest thing probably really is quality of earnings. Have you got recurring revenue? Lenders love proper recurring revenue. So software businesses, businesses with long-term contracts, all of that kind of stuff. Ultimately, lenders are focused on downside protection, aren't they? So if you've got reasonably good visibility on where your earnings are, they're going to be pretty comfortable what that downside looks like. Other things they're interested in: customer concentration. If you've got one customer, that's probably going to be challenging. It's not necessarily a death knell in terms of borrowing money, but it obviously does make it challenging. Having strong cash generation, obviously proving you have the ability to be able to service the debt and at some point also repay it as well. And then the last thing, which is really important actually, is just who the management team are. The strength of the management team, I think, is really, really important, and lenders will spend a lot. No one will lend money of any kind of great amount without having met the management team properly and spent time with them and got comfortable with who they are. And it's not just the CFO; it's the CEO. It's also the sales people. They're just, and they'll be very interested in who the second tier are within the business as well, and everything like that. So, good management teams, are backable, and lenders, will back good management teams.
Yeah, I would completely concur. I think the people credibility and presentation of a business, is so important in terms of driving fundraising. We've come across that, the time and time again over many years in terms of how that impacts the end goal. So that's great. So we've just talked about the how.
It's worth saying that it can very negatively impact. Actually, if lenders lose confidence, particularly in a CFO throughout a process, that can have a real issue. Yeah,
certainly. So we just finished another section, the how. So and key points coming out of that for me is defining objectives. Run a wide process and a rigorous process. You mentioned the fact that, interestingly, ESG is quite hot. And you also, I think was a very important point there at the end there about customer concentration, and whether this be a business that is about to start but has the potential for a strong customer concentration, or existing. I think that speaks that would speak very positively to a lender. So we have about 15 minutes left, so we're going to spend the next on the final section. What are the risks in the market? Let's spend about 5 minutes kind of running through this section. But in your opinion, Chris, at the moment, what are the biggest risks of taking on debt? I mean, look, there's going to be the obvious ones, right? But I think I'm kind of reaching out for the unobvious ones as well.
So the obvious ones is you're taking on financial risk. So you're bringing somebody in who's got a priority call on your cash flow. So you've got to think about, what does that mean if you do potentially underperform, or you don't generate as much cash as you think you're going to do. That's going to bring you into another risk, which is if you haven't borrowed any money before, you're now bringing somebody in who's a third party, who has a different agenda. Banks are very focused on getting their money back, not on supporting businesses through hell and high water and ploughing more and more money into it. That's what VCs are for. So you do need to think about what is that going to do to your business. It's going to bring restrictions. As I said before, you've got to define your objectives and then make sure you negotiate around what objectives are most important to you, and that's going to ultimately come down into the restrictions. So you've got to, the number of times I've met businesses who complain that the bank is getting in the way of them growing, and then they're doing things with their business. Well, that's because they haven't properly thought about what their objectives are, and therefore what's been restricted within the lending that they've got. This is obvious, but it might be not obvious. You're going to have reporting requirements. You've got to give information to lenders. They don't sit on the board. They're not shareholders in the business. They're monitoring of your businesses through information. And that might have bandwidth implications. If you're a small business, all of a sudden you've got and a lot of entrepreneurial businesses, fundamentally are run by looking at how much money is in the bank account. If you all of a sudden have to start producing proper monthly and quarterly fully integrated management accounts with commentary and stuff like that, then that actually be quite a burden on the finance function of the business. And some of the certainly some of the lenders, like asset-based lenders, some people underestimate how much information those type of lenders need in relation to the asset base on a fairly regular basis. So that's that it's obvious, but it's maybe slightly unobvious as well. And I suppose the other is just the covenants that you agree. You just got to make sure that you're comfortable about what covenants they are. They are the way in which the business is ultimately going to be monitored by the lender. So you just need to make sure you're setting achievable covenants with appropriate headroom.
Well, that's great. And look, I mean, I think, you know, a bit of sage advice from you, Chris, you know, around the pitfalls that you should look out for during the pre-deal discussions. So in the gear up to close, you know, what would you say that people should be looking out for?
Yeah, I would pay quite close attention to how certain lenders behave during that process, because you know how they behave during that process could be a bit of an indication of how they'll behave in a future relationship. That can be positive or negative. People can be very, very salesy, and then not deliver later on in the relationship. But I guess if you've got people who are very, very information focused, that probably means they're going to be quite information focused going forward as well. The key thing I would say out of anything is making sure you deliver on your numbers in the business as you go through the process. If you at the outset you say you're going to deliver X turnover, X profitability, and you don't by the time you get to do the deal, that's going to really negatively impact credit appetite. So the main thing is to make sure you don't take your eye off the ball while you're going through the process. And if as I said before, processes are quite information hungry. If you've got third-party diligence as well, it's very, very easy for that to happen. And that is a death knell for processes. Make sure you're fully prepared as you can be with information before you start talking to people. You want the way to get the best outcome is to run an efficient process. Is to do it in a timely manner and to give lenders information as you go along. Now there will be some questions which you won't have thought about clearly, and if you have an advisor helping you, they'll help you prep that information in the first place. But if you can be prepared and run a relatively smooth process, that actually encourages quite a lot of confidence within lenders as well, because that reflects potentially on how you're going to be running the business going forward. And I've said it before, and I'll say it again. If you haven't defined your key objectives at the outset, then that's going to be a big issue for when you come to negotiate the deal and try and work out what you think the best lender is.
Yeah, it's clearly a key theme in terms of the work that you've done with your clients. Defining the objectives. And I guess this leads nicely on to the last question, which is, once it's all done and dusted, I mean, it'll be a nice moment, but the story then begins. It's rather like a business going public. Everyone can kind of shout for joy, but then it's about what you do afterwards. So how should you work with the lender? I mean, what's important post deal?
The number one thing is communication. I think, having been a lender myself years ago, and now as an advisor, when things break down, it's because of a lack of communication. No surprises is the mantra. I think, people sometimes think, if things aren't going quite to plan, then they don't want to tell the bank about it or the lender about it, because they think that's just going to end up with a negative situation. I think actually in reality, being within reason relatively open about where things are and talking to your lending partner and treating them as a lending partner is probably the best way to go about doing it, because the people at the front end, the front line, particularly in banks, they're not the decision makers, so they have to go and speak internally as well. And if you all of a sudden dump on them that you're about to breach your covenants and everything's gone horribly wrong, they're going to look really bad internally. If you've spent time helping them understand where the business is, they can manage their own internal communications as well. So I'd say communication, no surprises, treat your lenders as a partner. I think that's really the kind of key going forward, and make sure you are providing them with the information that they're requesting.
Well, that's great. Thank you. We're coming up to the last few minutes, and may I just encourage the audience, if anybody does want to ask a question, please place it on the chat, and I'll ask Chris. We do have one question that I need to cover, but just in terms of the risks there, The risk section there, we've been talking about reporting requirements. You've got to give your lenders information. Perhaps when you're going through pre-deal activity, your judgment around a leader's behavior may have an impact on the success of the loan past completion. Hit your numbers, define your objectives, communication and no surprises. But I kind of like what you said just before, Chris, which is, treat your lender as a partner, as a business partner. I think that'll help you. I really do believe that will help you get through tough times and also easy times. One question from the floor is as follows. Do you expect to see the market adjusting to the new interest rate conditions rather than just pricing up ? We are seeing increasing rates across the world, and more so in emerging economies, third world, where rates are close to or in double digits, and yet funding continues. Obviously, it's harder, but the market has adjusted there. So the main question, do you expect to see the market adjusting to the new interest rate conditions rather than just pricing up?
My view is I think it will do, but it will take time. The banks don't really have a huge amount of leeway because they obviously do have to lend according to the reference. They lend according to reference rate. Technically, they don't have to. They could do fixed rate loans if they really wanted to, but everybody lends on a reference rate basis. So I think we may well see interest rates from banks come down slightly if risk profiles are appropriate for that. I do think, however, that in this market today, the ability for lenders to assess risk is a lot better than it was, say, 15 years ago or 20 years ago. So we do live in a bit more of a sophisticated information world. So you could argue that risk pricing is better today, and therefore lenders are pricing according to risk. The alternative lenders, the funds, who have raised capital from other investors, I think it'll be interesting. I've been talking to a lot of them and saying, well, you're all making super profit, because they all lend against a reference rate as well, even though actually most of them don't pass that reference rate on to anybody. So some of them will be making super profits this vintage on the basis of the reference rate going up quite substantially. Some of them think that might well get adjusted going forward. Some of them also think that they quite like to keep that increased return because their investors want to see that increased return. I think ultimately, lenders need to lend money in order to make money. So if it looks like the market is pricing itself out, then I think they will need to adjust. And if you've got a really good quality business with really good quality credit metrics, then proper competitive processes and competitive tension is going to ensure that you end up borrowing at a probably reduced, better rate in the first place.
Great, thank you. That's it's very interesting, and we have time for one last question, and I'll read this out. How has recent uncertainty in the UK, a la Brexit, Liz Truss, mini budget, etc., affected lenders pricing their risk and attitudes to lend money to businesses?
I mean, when that happened, in September last year, I mean, it obviously had a massive effect right there and then. But I kind of believe that, Liz Truss may well have stuck an extra 0.5%, maybe even as much as 1% on top of our, on where interest rates are going to get to. But I think we were probably going to get to where we are now anyway. So I think in reality, it's more the uncertainty that's come about in it which has affected it than anything else. Lenders don't really like uncertainty. It's hard to make a decision in an uncertain environment. If things are going down, then you can make decisions. If things are going up, you can make decisions. If it's a bit uncertain exactly what's going to happen, that tends to delay decisions, and that's, I think, what's actually happened more than anything else. And to say, our survey would suggest that lenders haven't changed their pricing that much at all. And and we're seeing live examples today where really good quality businesses are borrowing money at a margin, which is the same as they would have done 18 months, 2 years ago, sometimes even still less.
That's great. Thank you, Chris. Well, I'm going to draw proceedings to an end. First of all, thank you, Chris, very much for your insights and learnings. And to anybody on the session today, please do feel free to reach out to Chris via myself, easily done, or directly if you want any further advice in terms of raising debt and and what the market's doing right now. So thank you, Chris. And also, guess I'm really looking forward to seeing what your next big swim is going to be all about as well.
It's not going to be a swim.
It's not going to be a swim, right? Okay. May I also just say to the audience that hopefully you will have got to appreciate a little bit more about Fusion Consulting Group and also Fusion Recruitment. And if I can introduce you to any of my colleagues in relation to our other lines of business, please do be in touch. My job in the world to support interesting situations like debt funding is around the people side of things. So if any of you do want to have a discussion around your hiring strategies or your career or anything like that, please do be in touch. But Chris, thank you very much again. I really appreciate your time and help, and appreciate the audience turning up. And please do look out for our next webinar, which should be within the sort of next couple of months period. So thanks very much, everybody.
Thanks, Adam. Enjoyed it. Thank you.
Thanks,
Bye, everybody.